Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at rich tech robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. With a name like rich tech, especially in robotics, you're immediately hit with this core contradiction.
The classic growth story problem.
Exactly. It's this high wire act. You've got massive, truly massive growth potential on one side, but on the other, you have these deep, persistent financial losses.
Okay, so that's the classic high-risk, high-reward setup. Let's try to put some numbers on that. Let's start with the good news, the bullish side, the revenue.
Right. The demand for service robots is just, it's accelerating. And you can see it in their numbers.
Oh, so?
Well, if you look at the financials for the 9 months ending June 30, 2025, they pulled in $3.6 million in revenue.
And that's a significant jump.
It's a huge improvement, a real acceleration compared to where they were. It's not just slow growth. It suggests their new pilot programs are actually starting to scale. They're finding a market.
And that growth curve, that acceleration is what's getting people excited because it's frankly outpacing a lot of its peers in the early stage robotics space.
It absolutely is.
Yeah.
It tells you their solution is compelling, especially where labor is so tight, hospitality service industries.
And it's a big but. Let's flip that coin. How do they justify that growth when you look at the bottom line? Because those losses are wild.
They are. The losses are, they're massive. And that's just the cost of doing business when you're scaling hardware and software at the same time.
Okay, give me the number. How bad is it?
For a recent period, the net loss was about $4.54 million. But hold on, the really eye-watering figure is from Q2 2025. The net loss for common stockholders hit $12.16 million.
$12 million in a single quarter. For a company with, still pretty small revenues?
Exactly. That's a serious capital burn.
So where's all that money going? Is this just inefficient, or is it a calculated risk?
It's calculated. It has to be. That loss is a direct result of really aggressive and, you could argue, essential reinvestment into the company.
You see it in the margins, I assume.
Oh, yeah. The operating margins are deep in the red.
Right.
Just look at the gap. For one quarter, operating revenues were, let's see, about $1.17 million. But their expenses, R&D, marketing to get those pilots, cost of goods, were almost $6.11 million.
Wow. So for every dollar they bring in, they're spending nearly $6 to build the infrastructure for the future.
That's the bet. It's all a bet on the long term. They're using capital to build a moat, both technologically and commercially, not to post a profit today.
Okay, so let's talk about that moat. What's the prize they're chasing? Why should someone buy a rich tech robot? What are the real upside drivers?
Well, first off, this isn't just a concept. They're already out there. Rich Tech reportedly has over 400 robots deployed across the U.S. right now.
So they have real-world data coming in.
A huge feedback loop. And the market they're targeting is big and getting bigger. Projections put the service and hospitality robotics market at maybe $230 million by the mid-2030s.
That's a pretty decent runway. But to capture it, you need big strategic wins. And they've had a few recently. Let's talk about the automotive deal.
Right, that one's really strategic. They secured a pilot program with a top 5 U.S. auto dealership.
Why is that so important? It's not a restaurant.
That's exactly why. It shows their tech is adaptable. It can work in a complex showroom, not just a simple hotel lobby. It opens up a whole new vertical for them.
Diversification. I like that. What about globally? I saw something about a partnership in China.
Yes, a $4 million partnership in 2025. It's a joint venture.
Which gives them, capital and a foothold?
Both. It's a shortcut into the massive Asian market without having to build from scratch. And that $4 million is a nice piece of global validation for their tech.
Okay, those are good. But the one that really caught my eye was the Master Services Agreement, the MSA, signed in August 2025 with one of the biggest retailers in the world.
That one is the real signal.
Why is that so much more important than a regular sale?
Because an MSA is not a single purchase order. It's a framework.
Right.
It means this giant retailer has already vetted rich tech for the long haul, for compliance, for scale. It's the green light for potentially huge future projects across their entire network.
So this is how the pilot programs start to become real sustainable revenue.
This is the path. Now, all of this is the commercial side, but the tech has to be top-notch.
Right. What's the secret sauce? All that R&D spending has to be going somewhere.
That's all about the AI. Specifically, their partnership with NVIDIA. They're adopting the Jetson Thor computing chips.
Interesting. So they're building on top of NVIDIA's platform. Some might see that as a risk, being so dependent on one supplier.
It's a fair question. But the advantage isn't just the chip, it's what they build on top of it. The Jetson Thor is designed for high-performance processing right on the device, at the edge.
So the robot is doing the thinking itself, not calling home to the cloud for every decision.
Exactly. Faster reactions, smarter interactions in a busy, unpredictable place like a dealership. It lets them handle complex tasks that older, dumber robots just can't. That's their tech moat.
And that combination of commercial wins and advanced tech, that's what's starting to drive the market momentum.
For sure. And speaking of momentum, the biggest structural shift for them this year was getting into the big indexes.
The Russell 2000 and 3000?
A huge moment for them. It's not just good PR. It literally forces passive index funds and ETFs to buy the stock.
It's guaranteed demand from institutions, a huge liquidity boost.
And you can see that support reflected in the technicals. As of late November, the stock has shown a pretty clear bullish trend reversal over the last 3 months.
What are the specific signs you're looking at for that?
The clearest signal is that it's trading above both its 50-day and 200-day moving averages. That's a classic technical health check. It shows short-term strength and confirms the long-term trend is turning up.
So technically speaking, where's the floor and where's the ceiling right now?
Support seems to be building a nice base around the $4.50 to $5 level. The resistance, where sellers might pop up, is in that $6 to $7 range.
And if they get a positive catalyst, say a good earnings report, what's a reasonable target?
With this setup, a strong catalyst could push it toward that $6 to $6.71 range, maybe within the next quarter. The next 3 months are, well, they're pivotal.
Okay, let's map out that calendar. What are the key dates?
We have 3 big ones. First, the Q3 earnings report expected around December 15th. That's their chance to show progress on these pilots.
Then just before the holidays?
Yep, around December 22nd is the ETF rebalancing window. That'll affect liquidity. And then the big one, Q4 earnings and their forward guidance for next year. That's expected February 14th.
And of course, beyond the official schedule, there's always the market chatter.
Oh, the speculation is heating up. With their AI focus and those deployed robots, you hear talk of strategic alliances, maybe even M&A interest from a bigger tech player.
What about structural changes? I've heard talk of a potential Nasdaq uplisting.
An uplisting would be a huge deal for visibility with global investors. And there's also chatter about them expanding into logistics or fulfillment centers, which would just blow open their addressable market.
And what about governance? Any changes expected there?
The upcoming annual meeting of stockholders has people watching. You know, there's always speculation around executive changes or a board shakeup that could signal a new strategic direction.
Which brings us right back to the beginning. The risk. This is a great story, but it is a high-risk story. What are the key things that could go wrong?
Execution risk is number one, by a mile. The sales base is still small. The entire bull case rests on them turning these pilots, the auto dealer, the giant retailer, into repeatable, profitable contracts. So many robotics companies fail at that exact step.
They stumble going from a cool pilot to a massive, reliable rollout.
Correct. And that leads right to financial risk. Free cash flow is still deeply negative. History is just littered with robotics companies that had great tech but couldn't make the business model work at scale.
And finally, that means the valuation is pricing in a lot of good news.
A ton of good news. The recent rally means the market is assuming near-perfect execution. It's assuming those pilots will succeed and that margins will improve.
So if there's any disappointment in the next couple of earnings reports, a delay, a margin miss,
the stock could see a significant pullback. The margin for error here is, let's just say it's razor thin.
Okay, so let's tie this all together.
In conclusion, RigTech Robotics is, it's a compelling story for an investor who can handle risk and is focused on that long-term automation trend.
The losses are real, the risk is high.
Very high.
Yeah.
But the strategic partnerships, especially with that global retailer and the AI edge from NVIDIA, they create a really powerful foundation.
So the next 2 earnings reports are everything.
They are the critical checkpoints. You need to see proof that these big wins are turning into real, sustainable growth with improving margins. This is a structural play. It requires patience.
We hope this analysis helps you navigate the high stakes of the service robotics sector. Don't forget to subscribe to Smart Wealth with Joshua for daily insights that help you navigate the market.